Okay, hello everybody, and welcome to Investing with IBD, sponsored by Fidelity. I'm Allie Core, multimedia content editor, and I'm joined today by my co-host, Justin Nielsen, IBD Market Research Director. And this week's special guest, making his very triumphant return to the podcast, is Irusha Peiris. He's portfolio manager at O'Neill Global Advisors. And on this week's show, we have a lot to talk about in terms of the current market, what's shaping the market direction, and also how you can use industry group strength and the relative strength line to help you focus on what's working. And we're going to take a look, of course, at a couple of stocks and get some analysis from Irusha on that. So welcome, Irusha.
Hey, good to be here. Good to see what you've done with the place, and I'm a big fan of the show.
Yeah, I'm sure the audience feels very relieved to hear your voice back on the airwaves.
There's some sense of normalcy back to this place, huh?
Right.
Yeah, I wanted you to actually put as one of his titles, former host.
Yeah,
that would have been really good, actually.
Formerly known as.
Yes, exactly.
Goes by a symbol.
It's too soon, man. The wound hasn't healed yet, Justin.
Okay.
Well, we're glad to have you back on. It's a treat.
Thank you.
Well, let's get down to it.
Yeah.
Should we start talking about the market? Because I mean, today was
maybe
rough.
We should do more introductions.
Yeah, exactly.
I don't want to talk about the market.
Yeah, let's stall this one.
I know. It's we're afraid to look, but we must. So a really rough day here, and we've been talking about this bifurcated market and the weakness in tech, but it seems now like it's really spreading to other areas of the market, guys.
Yeah, this is the beauty of our system, right? The markets are always going to look ahead, and for months now, growth stocks have been they've been in trouble. They've been slowly being sold off at key points, and it just kept getting worse and worse. And yeah, I was trying a number of these growth stocks the last couple of months, and really since the beginning of the year, and it was just a struggle. Every single time I tried it, I was forced to cut losses. And we're starting to find out why. There's more evidence coming out, and obviously with the inflation numbers, the CPI numbers going through the roof, I think it was like the highest since 2008. This is an environment where growth stocks are not going to do well. But I think the beauty of the system is that the market always anticipates this. And if you learn how to read charts, it's been telling us for months now not to really be in growth stocks.
Yeah, I think that's one of the amazing things is how that technical action, they say that the market is a leading indicator, right? Not a lagging indicator. And so, again, this is something that we've been seeing in the NASDAQ for quite a while. The NASDAQ has, it has been clearly in a corrective phase. I mean, it started getting to those highs of February 16th, but really couldn't make much progress before starting to take another downturn. But even when it was getting back to those highs, it was really interesting because it was the former leaders not really participating. You see the advanced decline line on the NASDAQ composite was really not doing much. It was the Googles, the Apples, the Facebook, that's what was really driving the NASDAQ ahead. And I think the trickiest part, though, was it was really hard to, look at the S&P 500 and ignore the fact that the S&P 500 and the Dow Jones Industrial Average were at new highs. I mean, just last week, right? they were breaking out into new high territory, and now they finally are looking a little bit worse. So, what would you, I know this is a little bit of hindsight, but what should people have been looking at? What cues should people have been taking? How invested do you think people should have been during this market where, again, you had this bifurcation, our normal stuff wasn't working, but you did have strength in these areas that was undeniable. So what would have been your hindsight look at the way to play this?
Well, there are a couple of things. First, I think, and it's not necessarily hindsight, this is every time you just look at your portfolio, how are you doing, right?
Right.
The portfolio is going to be telling you whether you're right or wrong on your decisions. So that if you were in the wrong stocks, whenever you're in the wrong stocks, it's going to be telling you you're out of sync with the market. and it was very easy, especially for growth investors, to be out of sync most of the year.
Right.
So that was one thing. Relative strength industry groups, which I think we'll talk about in the next segment, those were the two key kind of indicators. Now, I admit, because I look at a lot of stocks, and over the weekend I look at a lot of stocks, and there were plenty of times where growth stocks did look attractive. But one thing that I've kind of gotten a little bit lazy on is looking at concentrating on the industry group ranking. Well, the market has really made me pay for that, because if that was a key part of your analysis every week, the top 40 groups, you hardly had any growth related type of groups there, maybe some retail and things like that, but it was pretty consistently energy, building, real estate, things like that. But a lot of it is just the relative strength, the industry groups, and the portfolio. Those are kind of those hindsight kind of things where you have to go back, do your post analysis, and figure out, you know, am I making the right decisions based on your performance? And I'll say one thing, this is the trickiest type of environment for us. This is the worst case scenario for our system, because it's a trendless system, right? And so every few days, it's going to tempt you. Hey, here's a stock coming up through the 50-day moving average, one of your favorites, trying to build the right-hand side of the base. Here's another stock that's breaking out on maybe low volume, but you're missing that the relative strength line is lagging. And so this is the choppy market, the trendless market, the sideways market, which is the most dangerous market for our system, right? We're a trend-based system. We do well in uptrends, like especially last year was ridiculous. And we can stay out of downtrends. But it's this trendless, indecisive market where you have this rotation that almost seems to happen every 2 days or so.
Right.
That's the one that can catch us. And that's where you really have to look at your portfolio and look at your batting average to tell you, am I in sync with the market or not?
Yeah, but there have been bright spots in the market, as you've been saying, the oil and gas, construction. Well, just to talk about these other areas that have been working. Do you try to hold those for home run gains if you've been able to, grab a couple of those over the last couple of months, or do you try to go for just a 20% gain? Because you have a week like this week, and you can even be taking some hits, off the top of those big movers.
Yeah, I think really that's up to each individual how well they do. Me personally, now the ones that I've had profits on, I've been taking them, because it's been rare that I've been right this year. So I've tried to be pretty quick to take those profits. If your sweet spot are these type of stocks, the Dow related stocks, real estate, building, where you really understand them, now you might have the conviction to hold on for those home runs and those big winners, because they have been trending quite well, and you might have caught them earlier, and you'll be able to handle the kind of the wiggles and wobbles that are going to happen in this more volatile market. So it really just comes down to what you're comfortable with. Now, I think most investors who have been studying the CanSlim system, this is not going to be our environment. A lot of us are just going to prefer to only be invested a little bit and mainly sit out on the sidelines. I know Mark Minervini says that it's either you're looking for the easy dollar environment or the hard penny environment.
Right.
A hard penny environment. And so in many ways, this is not worth it for most people to try. If you're really good at getting growth stocks, this is not worth trying this kind of hard penny environment, because you're just kind of getting whipped around, taking quick gains, things like that. It's more frustrating. You're better off preserving your mental capital, resting, and letting your type of stocks really set up for that next run.
And I guess two things that I found that have been a little bit more difficult. Number one, when you have the S&P 500, going to new highs, and the Dow Jones Industrial Average going to new highs, it's hard not to feel like, wait a minute, I'm missing out. If I'm not participating, then the fact that these are going to new highs, I'm missing out. And then number two, I think we've all felt that this is just not as a forgiving environment as maybe people got used to last year, where, you were talking about some of that, little lazy habits and bad habits that kind of creep in. And this happens to everyone. But man, I feel like every time those bad habits or laziness creeps in, I get punished for it. I really, I really get punished for any lack of discipline. And again, you can get away with it in certain markets like last year, but then eventually it's like, wait, if you start breaking rules, you're a lot of times going to suffer the consequences. And I think the relative strength line, as you were saying, is a big one. And we'll definitely get to that in the second segment. But what would you say to people? Is that just, do you stick with, okay, I'm not going to play those because that's not my style, or I'm going to shift and maybe play smaller ball, or what are kind of some of the ways to approach it? You kind of got into it a little bit, but
yeah, I would say, definitely if you want to play smaller, right? If this is not if these aren't your stocks, you don't understand them as well, play smaller, learn from it, right? Because they are trend. A number of those stocks are trending well, and there are a lot of lessons to learn there. So I would say, I always say, whenever you're learning anything, just start small, play it small, whether it's, trying these type of stocks or options or shorting or whatever, play very, very small, get comfortable with it, because all these different types of stocks are going to trade a little bit differently. So I think that's a good approach to this. So you're not really committing. I mean, people always think that, especially when you're newer, that there's always going to be a bull market somewhere, right? Mm-hmm. There's always going to be a way to make money, and the reality is, I mean, you don't necessarily need that to have, to grow your equity curve on a consistent basis year over year. Now, some years you're going to go sideways and go down a little bit, but you're cutting your losses and preserving that capital to really put it when those times are right and ripe for growth stocks to explode. So it's your choice at that point. But I would say play small. This is very unusual, though. It doesn't always happen like this. I mean, Justin, you've been looking at this for a long, long time. I don't remember a market. I don't really remember a market like this where the Dow and S&P were consistently hitting new highs, and then Nasdaq was like consistently going sideways or just on the verge of making new lows.
Yeah, I mean, you had 2000 where
2000, yeah, exactly.
That was where the Nasdaq was taking a harder hit. The S&P 500 and Dow Jones Industrial Average were certainly coming down, but the Nasdaq was just getting destroyed. I mean, it was down 79% from the high to the low, whereas the S&P 500 and Dow Jones Industrial Average were a little bit more muted in terms of their correction. But and then in 2016, after the presidential election, and we talked about this on the show, you did have this bifurcation that kind of happened as I think people were shifting to, okay, what's going to happen in this administration, and shifting to those ideas of, okay, and to a degree there was a little bit of chasing, like, oh, is it going to be infrastructure, or is it going to be this, or is it?
Yeah.
And so there was this kind of rotation underneath that, was. You look at 2017, and it was such a phenomenal year for the indexes, but it was really easy to get destroyed underneath the surface, because there were these very light pullbacks. 3.4% I think was the max on the S&P 500, and underneath you had this rotation, that was happening, which did make it difficult. And I guess going forward, that's the question here. The S&P 500. It's not even at its 50-day moving average line yet. So is this seeming like it's, potentially a bigger issue, the start of something bigger, or is this just another pullback to the 50-day moving average line, and then you have to be ready to go again?
Well, I mean, yeah, you could, a lot of times I think the best thing to do is you have to be as objective as possible, right? So we're looking at the chart of the SPY right now. It's right at the 50-day. If you wanted to, make a trade off of this and say, I'm gonna buy here and keep my risk maybe 3% below, 3-4% below the 50-day, you do have some kind of trade right there. And especially for regular stocks when they're trending well, a lot of times you want to take those trades in a good market. So you could take that same approach here. The one thing I was going to mention is if you don't want to buy you don't know which energy stocks to buy or what Dow Jones stocks to buy, you can always buy the ETFs for these, right? And that's what I've done. I just bought a few of these, and XLE is one that I bought. I was like, I don't even know what energy stocks, but I do own XLE because I see underneath the surface a lot of those energy stocks are trending well, and I can handle the volatility a little bit better on this ETF versus one of the individual stocks.
Yeah, Justin, I know you're a big fan of this approach as well.
Right. Yeah. And so XLE, of course, is the SPDR sector fund for energy. And you know what? I think this is a good transition. When we come back, we'll go ahead and get a little bit more into the industry groups, the relative strength, and that'll be coming up in our second segment. So stay tuned.
Fidelity Investments is hiring now. If you have a Series 7 financial license, you'll find opportunities for both remote roles and regional center careers across the country. At Fidelity, we provide opportunities to help you change lives every day while making sure you have benefits that make an impact in your own life. Flexible work environments, training, and resources to help you grow, all adapting with you throughout your career, because your workplace should work for you too. Visit fidelitycareers.com to explore jobs today. Fidelity is an equal opportunity employer.
Welcome back to Investing with IBD, sponsored by Fidelity. I'm Justin Nielsen, along with my co-host, Ali Corum, and our former host of Investing with IBD, our special guest this week, Irusha Peiris. Now, Irusha, we were talking a lot about how difficult this market has been. Two lessons that you can kind of maybe impart to people who maybe are new to this, industry groups and relative strength. Let's go ahead and start with industry groups. And what do you look for to kind of determine where the strength is and where you should be looking, what pond you should be fishing in?
Yeah, well, I think the easiest thing to do with industry groups is just take a look at the overall ranking in the 197 industry groups. And a lot of times you want to focus on the top 40 industry groups. And so I'm not sure if we can, so let's just take a look at that. You have oil and gas as the first two groups, retail department stores, right? Oil and gas, retail steel, transportation, retail apparel, which is a little bit of growthy, metal products, wholesale jewelry, building, media, books, chemicals. This immediately is telling me this is not our environment right there. Right? Just by looking at the composition. A lot of times when you're in a great environment, especially like last year, they were all like computer software enterprise, computer this, computer that, right? Just all these.
Those are some of the lowest this year.
Yeah. And they almost flip-flopped, right? All the ones that were at the bottom from last year, they all rose to the top. Like energy, I think, was all the energy sectors at the bottom last year. Now they've all come back up. And all the growth stocks, all these stocks that didn't have a lot of earnings, the cloud stocks didn't have a lot of earnings, but had tons of sales, which did really well last year. Now they've reversed and they've gone all the way to the bottom. So the first step I think you could do is just look at just a snapshot and say, okay, where's Wall Street placing its bets? Right. And in those top 40 right now, they're placing it and everything but technology stocks, right? So it tells you, and that's been pretty consistent for the last few months. It's just been like that. So you can take a look at it that way. Now, another way you could do it is looking at the Grill 250 and just take a look at the stocks that are coming through the Grill 250. And so you can do this on the weekend, and you're going to get a lot of the same type of stocks. A lot of energy stocks, things like that. But Ali, so if you maximize the bottom panel for 1 second.
Yeah.
And so when you're on MarketSmith, if you're looking at the bottom panel, if you scroll to the right, there's a column, an industry group column that keep scrolling to the right. There you go. And so there's with the industry names, there's industry group rank and the industry names. So the way the MarketSmith Growth 250 is sorted, it's sorted by industry group rank, and then within the rank, composite rating. So a lot of times what I like to do, and I used to do this a lot more in years past, but I would just first scroll to the right, look at industry group name, and then I'll just look at the chunks. So, okay, there's a lot, there's like, 7, 8 stocks in oil and gas. And I scroll a little bit more, there's a number in retail, scroll a little bit more, steel. And so that's really showing me where Wall Street is placing their bets. These are companies with, they're good companies with a lot of potential, and it's so good enough that they're being picked up by the Growth 250, and meaning that Wall Street is starting to put more and more money on it because it's starting to show a little bit of relative strength or maybe some earnings. So those are kind of the two quick ways that you can go to really kind of just get an idea of where the money's going underneath the surface.
But I think then this begs the question: if growth stocks are out of favor, and the CNA and Can Slim are that strong earnings growth, a lot of the stocks that are outperforming right now don't have the typical fundamentals that we look for. They're more of these turnaround plays, but they have the exceedingly strong technical action. So I think, when we talk to a lot of people on IBD Live or on Twitter, that's kind of the rub is, well, these don't have the fundamentals that I'm told are needed to increase my odds of success.
Yeah, and so that in itself, if you want to be more of a pure Can Slim investor, that in itself is telling you shouldn't have as much exposure as you probably had last year, right? Now, there are still some stocks that have growth potential within this, or there are times where you go for, like you said, the turnaround stocks. And there have definitely been times in market cycles, 2007 is one that comes to mind, where the commodity stocks just went through the roof. And so you're going more, and they actually, a number of those commodity stocks do have some really good earnings and sales. So they do fulfill the fundamentals that we look for using Can Slim, and they have the relative strength and the price action. So sometimes you have to parse it a little bit fine and also be a little bit more flexible to go towards where the money's going if you really want to participate. So if you want to have exposure to market, then you want to go where the money's going at that time, what the market's telling you where it's going. Or you can say, you know what, I'm just not gonna play that much. Maybe I'll just put a little in ETFs and I'll just take a break.
So I've got kind of a two-part question here. Ali, if we could go back to the first screen that you showed with the industry groups, I was wondering, do you ever look at the directionality? Because I mean, that's something that you certainly mentioned, how a lot of the former leaders, we have seen them kind of flip-flop. And one of the ones that jumped out at me was when you were looking at the bottom, energy solar, which was 3 months ago, 6 months ago was number one, number two, and now it's down at the bottom. And then you look at some of the others, it's flip-flop. Do you look at, because MarketSmith does show you kind of that directionality? Is that something that you look at, or is it just like, what, I don't care really where it's been, I just care where it is right now? No,
you bring, this is a little trick that I will show, that I've shown MarketSmith customers in the past on webinars. So for those of you, you definitely want to watch the video version of this, but sort by, so when you're on like the, so you're in the industry groups. And so if you want to sort by the 3-month column, right? And you're going to put the worst at the top of the list. So if you click on that once, there you go. So now the worst at the top of the list, right? So 3 months ago, soap and the soap group.
Cleaning preparations.
Yeah, cleaning thing. I was like, clinging? I don't know. But the soap group was at 197. They're the worst group. They haven't done that much. But what I'll do is I'll look at the industry group rank column, so the current rankings, and I'll just scan down and look for actually double digits, right? So you're looking at the worst groups, and as you scan down, you may see some big jumps. So Ali here is highlighting the retail wholesale auto parts group, which went from 191 3 months ago, and it made a jump to 96. Now there are only 8 stocks in it, but still, that's something's going on there. If you scroll down a little bit more, let's see. There's the insurance, the dividend diversified is not 93, right? So they went from 163 3 months ago to 93. Then there's the building from 158 to 73. So in just 3 months, it went from 158 to 73. So there's some money going into that to drive it up. So this is a way to kind of maybe get a little bit ahead of the curve on some of these groups, because you'll start seeing a jump in some of these groups, especially after an earnings season where more money goes there, because Wall Street's starting to figure out that these groups this is their time in the market cycle where they make a lot of money.
Yeah.
And so, yeah, I will do that from time to time just to see where the big jumps are. And then I'll just double click and look at the stocks in it.
Right. I was just going to say, you mentioned how there were a couple of these groups that didn't have a lot of components in the group. And because it's also a price weighted index, sometimes you can get one stock almost dominating the group because it's just a higher price stock. And so I think that's where it is key to kind of do that next level down, especially if there's not that many stocks in there. I'll look at all of them and I'll just say, hey, is this something where it really is a group move, or is this one stock that's just kind of taken over? And then if that's the case, is it still, indicative of something that's going on in that industry because it's got that new factor in there?
Yeah,
most definitely.
And then really the final way you can do it is kind of like the bottoms up approach. This is more kind of top down. We're looking for, first, obviously the highest top is markets, then industry groups, but working from the industry group level, you can go bottom up. If you're looking at enough stocks like the Growth 250, or sometimes I'll look at a lot more stocks a lot of the time, and you'll start noticing, wow, there are a lot of stocks in the building group or the building sector that are forming bases, that have shown some nice uptrends. They're starting to form bases, and some of them might be emerging. Now, the oil and gas U.S. exploratory group, this is a good example here. They've had a really nice, strong run over the last few months, and they finally formed some bases over the last month or so, and now they've started to merge out of those. These are the first bases that they've actually started to form. So now they're starting to move, and they're ranked number 2, and so they're actually giving kind of the more traditional opportunity to get into some of these stocks.
Yeah. So then, how do you know if it's too late? So say you're looking at the industry group strength. What then are you looking for on those charts to help you determine, okay, this is where I need to be putting my money?
Yeah. Well, the easiest way to do that is looking at when the stock goes through a run, it's going to form a number of bases along its path. And so that's one way. We call that stage counting. I don't want to really get too far down into that level, but if a stock's been going up for a while, and if it's formed 3 or 4 of these bases, a lot of times it's become a lot more obvious. And when it becomes more obvious, if you start hearing people talk about it, or CNBC talk about it, it's become obvious, and you want to be a little bit more careful there. So that's one thing. Just see how far it's run, and if it keeps emerging out of it, the probability of it working as well is less at that time. So that's one thing. But here's the reality though. If it's a stock that I really like, a company that I really like, and even if it's gone on a big run, I sometimes will take a chance at it if it's breaking out powerfully and has everything going for me. It's a great earnings report, things like that. I'll still take a chance because anything can happen in the market, right? You just don't know. Right? So anything can happen in the market. I'll take a chance. The difference is, if it's a later kind of stage base, it's been running for a long time, I'll be quicker to get out of it. Because now I know I'm playing with a lot more risk at this point. And if it's going to fail, it could fail really bad. So I'll just be quicker to get out of it. But you're never going to know in the markets for sure. That's really one of the hardest things for people to get used to, because a lot of people who start getting into the markets are really smart people. They've excelled at their profession, and a lot of the professions are black and white for the most part, right? There's a kind of a set rules, and if they get really good at it, they can just reproduce that over and over again. Guess what? In the market, anything can happen. The markets are insane. And so even though we have all these rules, it puts structure in place, but you still know that this is just probabilities. And so if it's a great company that's breaking out, I'll still take a chance, maybe smaller, I'll adjust for that risk, because I know that there's a chance that it can go from, say, a 4th stage base we consider kind of a late stage base. I've seen 4th stage bases go to 6th stage, 8th stage, and so you don't know at that point. So,
or if you get a climax top, then you've got one of the most powerful moves that you're going to see it. And
exactly.
Yeah, definitely. I think it also might be helpful if we take a step back and talk about why there is such this importance on industry group strength a little bit more, because you talked about a number of technology stocks in this last move up that we saw by the NASDAQ. There were a lot of stocks that were teasing you and just the shiny objects that are just making it so compelling for you to try those, and they didn't end up really working out, maybe.
Yeah, and this is kind of the downside of knowing companies too, right? Really starting to understand them and developing conviction. We always talk about the great having conviction when the stocks are trending well, but these companies are really great companies. But
the stories are so compelling.
They are. They're very compelling, and they really are great companies. They're going to be around for a long time, and the odds are they're going to do really well. But there are clear times in the market when they're out of favor, and there's going to be disconnect between the company and the stock. Right. And so you may be right on the company over 10 years, but the stock might go down for 2 years, and you may lose 60-70% on that investment. Right. So I can go over some examples here of companies that I really like, but I started to understand the hard way by losing money that, okay, the environment is changing here. So we can go we can pull up like a trade desk, ticker symbol TTD. And so you can see, like in February, Trade Desk came back above the 50-day moving average, and it's around there. And then it also reported it got through earnings and it started to move up. So that was right around the time where I tried it. Now this was an ugly cup with a handle. Notice pattern recognition did not call it a cup with a handle, but I said, what is pattern recognition now? I think it's a cup with a handle. And so I tried it, and then the next day it sold off, and I was like, okay, that's not right for it to sell off that quickly. So something's off. So I sold like half my position. And then, of course, the next day it gaps down massively on that. So I had to close out the position right there. So now, do I regret trying it at that point? A little bit, but not that much, because a lot of times it's just a numbers game. But really, look, I knew what I was doing getting into this stock. I was parsing it fine. I knew that it wasn't a great pattern. The relative strength line was nowhere near new highs at that point, so it was lagging at that time. And it shouldn't have reacted that second day like that. So there are a number of things here that I was like, I'm cutting it close. So I did actually go in smaller for this, but I still paid dearly because of that gap down on that day. But these are on the cards, right? So that's one. Pinterest is another one where I was lucky to get out of this without really getting hurt too badly. But I did. So as it came back about through the 50, I didn't buy it there. Usually I will start buying some, but I was probably smarting over the trade desk, losing money on that. So I passed on this one. It started to move up after 4 or 5 days, and of course now I'm upset that it's like, oh my god, I missed out on this trade. Because Pinterest is such a great company, it's probably going to go up to 150 from here, and I'm going to miss out on it. You let the emotions get the best of you. So I started buying a little bit as it pulled back. And then when it started to emerge out of that, once again, pattern recognition did not call this a cup with a handle. But I said, what is pattern recognition? No, I'm going to try it here. And so I tried it. But when this reversed quickly, I said, okay, trade desk caught me. Now here's one. Okay, I'm going to get out of it. Worst case scenario is if it does break new highs, I can buy it again. And so this one, I escaped barely on this, because then it really blew up, and so when Pinterest really got hit like that, those are kind of little warning signs going, okay, something's off here. This is not the behavior that you see when stocks are being accumulated, right? It just happens day by day. You'll see little clues like this. When stocks are being accumulated, they behave a certain way. When they're being distributed, they behave another way, where they kind of go up, they'll tempt you in, they're ugly bases, and then they sell off hard. And so that's one. Shopify, one of my favorite companies, and a stock that I was in a lot last year. Mm-hmm. This is one that I was like, oh, let me try to parse and get above, as I was trying to get into the above the 50-day. And once again, it almost did very similar to Trade Desk. And now I had the Trade Desk experience in the back of my mind, because almost identical. So I tried it, but when it reversed the next day, I was quickly to get out of it because it's like, this looks just like trade discord. It does it a little bit, really ugly kind of cup with handle. And then they sold it off pretty heavily again. So all these patterns, first of all, the first warning sign is these are terrible patterns, right? They are not sound cup with handles. Second, relative strength lines, you can see on Shopify here, consistently lagging. They were consistently making downtrends. The relative strength line is going to be your best friend if you learn how to use that in an analysis process, because Ali just switched it to a weekly chart right here. This relative strength line has been lagging for the longest time. It's just been making new low after new low. And so it's been telling you for the last couple of months that, hey, Shopify is not a leader in this market anymore. It's just lagging, and look for something else. But
sometimes that's hard when something was the leader and maybe you made money on it. And again, as you said, you got to know the story so well.
Yeah. And I know Shopify is going to be around for the next 10, 15, 30, 40 years. It's an incredible company, and what they're doing is amazing. But that does not necessarily mean that the stock can't correct 60, 70% from here, right? Anything's possible in the markets, and especially with inflation rising, all that kind of stuff, they will hit these growth stocks pretty hard if things get worse on that front.
Well, an important statistic that people should remember is that, when we look at what we consider these model book stocks, these stocks that have had, the greatest moves, when they correct, the average correction is 72% from their top, and so when you're talking about this is what they could do, this is what they actually average, and again, some of them come back. About 12.5% will come back and lead in another cycle, but you just have to know, hey, do you want to sit through a 72% correction? Because that's the average, and that's over a long period of time, not just 2000 .com bubble, not financial crisis, not coronavirus. That's over a long period of time.
Now look who's being the Debbie Downer here.
No, that's the warning. Again, that doesn't mean that's going to happen, but you always have to be prepared for that, and that's why we don't try to buy these, on the way down.
Yep.
The buying on the dips, again, that can just be a recipe for disaster. It can work great for a little while, but then when it stops working, if you keep on buying on those dips and averaging down, it's you're gonna lose a lot of money.
Well, and this is why I love risk management, right? Because I just showed you 3 really dumb trades that I made this year. And I didn't know they were dumb at that time, but what saved me from really losing a lot of money was I had an exit strategy.
Yep.
Once the rules got me out, even though I was like, once I sell it, I'll probably go back. It doesn't matter. I have a plan, and you have to trade those plans and exit when they go against you. And that's what's going to enable you to survive long enough to participate in markets like 2020.
That's exactly right. So industry group strength, extremely important to focus on, as well as that relative strength line. We can't say it enough. That is a huge component of our technical analysis. So we'll have to see that in action when we come back, when we take a look at a couple of stocks. We'll be back soon.
Fidelity Investments is hiring licensed financial professionals now. Reach your career goals with the support of a financial lender impacting customers and employees' lives for over 70 years. We're hiring now with remote roles nationally. So if you thrive on helping others, if you're self-motivated, find career growth at Fidelity. Find stability you can count on. Find the flexibility you want and the opportunities you need. Find your Fidelity. Visit series7.fidelitycareers.com. Fidelity is an equal opportunity employer.
Welcome back to Investing with IBD. Ali Corum here with Justin Nielsen and Irusha Peiris. So let's talk about a couple of stocks right now. Irusha, I know you were saying you were having a little bit of a difficult time coming up with this list, and it seems like that's kind of a function of the market that we're in right now.
Slim pickings.
Absolutely. It is slim pickings. These are companies that I don't own, but they're stocks that I don't own, but the stocks are trending, and so they are showing some relative strength. And so let's take a look.
Okay, well, first up we have Valero, ticker VLO, in that oil and gas sector, group 48 in the refining group, forming a cup base here. So what do you think about this action?
This is the first really nice base that's formed, and I know it formed another base a couple of months ago. There's a consolidation. That was almost like that was essentially a cup with handle too. It just wasn't as nice and U-shaped enough. But you're getting you have a clear, nice prior uptrend, and now it's pulled back, found support on the 10-week line, and formed a much more constructive cup right here. And maybe it's a handle by the end of the week. So the technical action is good. The relative strength line is acting well. The relative strength rating is 78, so it is outperforming 78% of the stocks in the database. Now, the reason why Valero also stood out to me was I just remember years ago Valero doing well, and when the oil groups were acting well, Valero was just one of these. And yeah, you can see in 2003, 2005. So now sometimes that can, it's almost this kind of the similar concept that we're talking about, that I went back towards some of the stocks that worked well for me in 2020 with Shopify and Pinterest and things like that. Like way back when, this stuck out to me because I didn't participate in this at that time. It's a strong brand name. It's a big company. Now you're not gonna pick this up on earnings and sales, right? They have no earnings. Their sales are terrible, but this is a completely different type of stock than we normally look for. Usually we're looking for game-changing stocks, game-changing companies that are new companies that are coming in, and they're producing a service or a product that everyone needs to have or use. Valero is they're just this monster company that they have this product that everyone has to use. It's not necessarily, there's a lot of competitors in it, but once oil prices get up to a certain point, and they can start selling that with great margins. This is trending well. This is so doing some research here on this, I think, would be worthwhile. It tried to break out this today, right? And I noticed it this morning, and I was like, maybe I should try this. But once again, this is, I think, another example of this is not a breakout type of environment that you want to try. And a lot of times with commodities, you don't necessarily want to buy them on breakouts. You're generally better off buying them on pullbacks. And so put this on the watch, just read about it a little bit more to develop that conviction, and wait for maybe a little bit of a pullback or for it to settle down a bit. And this might give you a chance to get into an oil stock if you want to get exposure in this type of environment.
Yeah, and I will say that that move that you were mentioning back in 2003 and 2004, I remember, I was working for Bill O'Neill at the time, and I was watching him buy this, and I'm looking at it. The fundamentals aren't there. I was fairly newer to the system still, and so I'm like wondering why is Bill buying this? Has he not read the book that he wrote? And one of the things he explained is like, look, you got to sometimes look at the conditions in the industry. that new condition in the industry, what's changed there. Same thing with the fertilizers. That were kind of moving at a similar time. He was explaining to me like, look, it's not that the fertilizer industry has changed, but there's something going on that's putting these extra pricing pressures and everything that's what's changed, where people are wanting more oil because this huge production is going on in China, or there's more food production, or all of these different things, and they work in tandem. So you kind of have to understand that new can also be what's going on in the industry.
Yeah, well, I will tell you, Justin, that when Bill O'Neill, this was like 10 years ago, which is pretty amazing now. And Justin, I know you remember this because you went too when Bill O'Neill went around Los Angeles and did a number of free meetups.
Right. Yeah.
And I went to a number of them because I was really excited to go and hear him speak. And there was one meetup, and it was actually at Manhattan Beach, not too far from where I am. He spoke, and he had his How to Make Money in Stocks book there, and he left it on the couch when he went up to speak. And so Amy Smith was there, and so Amy grabbed it, and she showed the book to me. I have never seen a book more marked up.
Yeah.
So Bill O'Neill marked up his own book with so many notes.
Wow.
So yeah, he's read the book, his own book many times.
He has. Yeah, great story there, Justin, and Irusha, of course. But For this energy sector, Irusha, even though we're talking about Valero here, just to be clear, you're opting to play this group with in the ETF.
With ETFs, yeah, if I want to get into some of the stocks, Valero will be one of the ones I'll consider. I'm still debating it. There are a few others that I've passed on over the last few days because I just wanted to put it more in the ETFs. But these stocks are acting well. It's just a little bit. It's going to get a little bit more tricky if the market acts like this, right? Where it's one day they're acting well, and the next day they take all those gains back. Then the next day they gap up again. Then the following day they take it all away again. When that kind of happens, it doesn't matter what stock it is, and it doesn't matter if these are the outperforming groups and they are in solid uptrends. It just gets very tricky if you're watching them too closely. And so you just got to know. You just got to know when times are right that. When times are right and when the environment's right for you to do well in. When are you going to be able to do well in these stocks or not? And right now, I just know just by past experience that these aren't environments that I just do well at. And so a lot of times the best answer is not to do too much.
Well, and that's kind of that definition of that hard penny environment.
Yes.
It's you're struggling to make every last penny, you're struggling just to get pennies. And meanwhile, when you take a loss, it tends to be bigger. So again, the ratio gets all messed up, and that's what really makes it hard to make progress in that type of environment, and why sometimes it's best to just sit on the sidelines for a little bit until it works itself out.
Yeah, and you also know if it's a hard paying environment, if you start to talk to others who are doing the same system as you and they're struggling too, right? Or they're not like they're really having to try hard to just scrape and get by. The market can be, as we saw last year, it can be very, very easy when you're in the right stocks at the right time, and it can be very hard if you try to force money out of the market.
Yeah, well, is Sherwin-Williams one of the right stocks for this year? It goes with that economic reopening theme kind of, but also it just a lot of people are remodeling their homes right now, buying paint. It's in the chemicals group, not quite nearly as highly ranked as the fertilizers, but Sherwin-Williams has gone on a pretty nice run over the last couple of weeks.
Yeah, and this is one in the past that I've actually bought because they have a strong brand name and they were one of the leading stocks at that time. So I like to try it because it's a little less volatile. I don't have any shares of it right now, but this one over the years I've noticed it can also trend very well. And yeah, Ali just pulled up a monthly chart here. You can see this is obviously they are the big player, right, in the paint industry, and they keep acquiring companies and keep consolidating that industry. So this is something that I'll notice when it's doing well, but I'm not always in a rush to get into it. But yeah, I mean it's just another way to play the housing boom and the real estate market.
So what do you think about where it's at right now? Want to wait for a base to form, some sort of pullback, something?
Yes, yeah. You just because these are great companies and they're actually working right now, and this is only 4.5% off its high, doesn't necessarily mean you run and buy it at this point. That this is way extended. It's 11% from its last base, which was a flat base, and so if you missed it, you missed it. And you just put it on your watch list and check it every week. And there's going to come a point where it's going to come in really hard. It's going to all start selling off like a lot of other stocks, especially if the market continues to go lower. And then it's going to go sideways for a while and potentially form another base. And that will be the next time. If it completes that base and emerges out of it, that will be your next time to get into it. And if the other kind of thing to do is if it doesn't do that and it's just more kind of going sideways, the 50-day moving average could catch up to it, and then it could give you an opportunity to buy off the 50-day moving average, which was a good move for a number of those energy stocks, the oil stocks in the number 2 group. Those stocks all pulled back perfectly to their 50-day moving average over the last few weeks and then completed their bases.
So you were mentioning, some of these are coming down pretty hard. Let's maybe take a look at another one, XPO, that you were bringing our attention to. This one, it's in that transportation logistics. Transportation has been another area of strength. The Dow Jones Transportation Index has been doing well. So it doesn't quite show up in the industry group here, but that sector has been doing well with some of the rail and others in that sector. But down today 5.7%. What does that say for this great relative strength line? And it can still go down, right?
Yeah, it's gone on a great run. It's finding support off the 21-day moving average, so it could hold there. This is one that just emerged out of the base around like 6 weeks ago or so, and it got a little tricky too, right? It tried to break out, it came back in hard, shook everyone out, and then took off. And a lot of stocks have done that this year, where they have this kind of really tough shakeout after the breakout, and then they work. So this one really could continue to find support off the 21-day moving average. Now, when you're in a great market, and if it's a stock that I really like, I will sometimes say, let me buy a little bit off the 21-day and just use the 21-day as my exit strategy. David Ryan calls that more the mental health buy. If you missed it and you're kicking yourself, sometimes I'll do that just to make myself feel a little bit better. But this is a same kind of approach, though, and that's the beauty of How to Make Money in Stocks book by Bill O'Neill. Yeah, there aren't that. I mean, it seems like there are a lot of rules, but there really aren't. It's just manage your risk and wait for proper setups to buy. And so, same thing here. Let it pull back to the 10-week line, the 50-day moving average. It could give you an opportunity there. These guys, what stuck out with this story with XPO Logistics is that they're the last mile type of delivery, and right. As obviously e-commerce is getting stronger and stronger. It's harder for these bigger companies to always deliver the big products, especially like TVs and stuff like that, to customers. So XPO Logistics really kind of grabbed that part of the distribution and really made it their own. And so it went on a great run in 2017, and it's been trending quite well here. So this is one that's on my watch list, but you want to wait for it to set up again.
Mm-hmm. And if you're ever playing the alphabet game while you're driving with your kids, it's great for getting the X. I will say that. Let's maybe take a look at a final stock, MED.
Yes.
Just real quickly. This was another one that was on your list.
Yeah. Mm-hmm. So Medifast. Now this is more of a growthy type of stock. And Medifast over the years has gone on some amazing runs. They reported earnings last week. It had an earnings gap, and so it had the catalyst to emerge and go into new highs. It actually, so you have the strong breakout. Now it's pulling back, and if you go to the weekly chart, Ali, you can see it's actually getting the blue dot too, right? So that's what kind of stuck out to me here. It's like, oh wow, a stock that's breaking out and actually having an RS line hitting a new high, and it's more of a growth type of stock. They have solid, really good earnings actually, and their sales are very consistent. They're in the weight loss business, and what's kind of interesting about Medifast is they have a lot of coaching. So not only can you get the products from Medifast, but they have a coaching kind of aspect where you talk to a weight loss coach to keep you on track. And so they have it is an interesting model, and they've done well. And you can see this on the weekly chart. Look back in 2018, when the stock gets going, it can really move. And it is kind of impressive that it's back in all-time highs. I mean, it corrected. I mean, Justin, you were talking about stocks correcting 72%. Yeah. This one almost seemed like it did, and it's recovered all the way. So they seem to keep impressing Wall Street when the time is right for these cosmetic and personal care groups to work well. It always seems like Medifast is like one of the best performers in this.
And as you mentioned, there's a lot of blue on that fundamental side with the earnings.
Definitely.
And 47% EPS growth rate with an earning stability of 13. I mean, that's pretty good.
especially with the way the chart, because the chart seems a little bit more volatile. So earnings stability of 13, and the lower the number, the better on for earnings stability. That what that's telling you is that this company is pretty consistent at meeting earnings expectations. And so, yeah, that's actually pretty surprising for a company like this.
Well, you know, Irusha, we talked about both that relative strength line and industry group rank being so very important. Which one is the dominating factor? Do you go with the relative strength line blue dot here, even though it's group 117 out of 197? Does that strong RS line outweigh perhaps, you know, it not being in the top 40?
No, and that's a great question. If a stock is in a really poor industry group, kind of like Medifast right here, 117 out of 197, that's a big negative. But I've learned over the years that there are no showstoppers. Like one rating isn't necessarily going to eliminate a stock for me. What I'm going to do is, okay, that's a big negative. Does a Medifast have enough positives to overcome that big negative? And so that's you kind of do the exercise that we were just talking about right now. You look at the earnings, you look at the sales, you look at the story. And if it has enough positives to overcome that negative, then you take a shot and see what happens. The way I kind of learned that was years ago, I saw Apple in 2004, and Apple's industry group was 120. And it was breaking out of its cup with handle at that time. I was like, wow, the computer industry group is terrible, but Apple's breaking out this cup with handle. Should I buy it here? And the answer was yes. You know, it was a terrible industry group. Actually, the relative strength rating was only a 54 at that time, but it had huge earnings, huge sales,
and it was doing something very different.
It had an iPod, exactly. It was no longer a computer company, right? So you always have to weigh the pros and cons. When you learn the system, when you learn these rules that we talk about here, and that talk about throughout IBD and the podcast on IBD Live, it seems very black and white. These are all the rules. These are all the rules. But the more you learn about it, there's a lot of gray in there.
And exceptions.
And there are exceptions, exactly. And so that's where experience is going to start taking over. And you're going to be kind of weighing the pros and cons. And eventually, you're going to take all these rules in the system and make it your own. You're going to start learning that you do better at certain stocks than other stocks. You do better in certain environments than other environments. And you're going to really cater it towards your own personality, and that's the way you're going to get better and better at this, because now you're really personalizing it, learning from your mistakes, and writing rules for yourself to get better at managing these stocks.
And that's what it's all about, getting better. Well, Irusha, thank you very much for joining us today. It's always a pleasure to have you on and in the hot seat and the guest seat. So thanks a lot for coming on today.
No, it was great to be here, and thanks for having me.
Absolutely. We'll have you back again. Next week, Sarah Ketterer of Causeway Capital Management will be joining us, and make sure you tune in next week for the show, and we will see you next week. This is Justin Nielsen along with Ali Corum, the co-host of Investing with IBD. Thanks a lot for listening and watching. And for this week's notes and charts, make sure to go to investors.com/podcast, where you'll find details for each episode in the podcast episode section. And make sure to subscribe, rate, and review our podcast if you haven't already. We'd really appreciate it. You can also send us your questions and comments to investingpodcast@investors.com. We would love to hear from you and may use your comments on an upcoming episode.
Hey everyone, thanks so much for watching Investors Business Daily on YouTube. If you want to watch more videos, make sure you hit that subscribe button so you don't miss a thing.